All right, guys, welcome to day 7 already of Anomaly sequence. Um, Tuesday, a little bit of a later upload, so my apologies for all the diehards here. Love that. Today we're going to be going over more technicals, going to go over price fractility, and pretty much showcasing you guys how you can set your entire narrative correctly by just looking at the most significant things first. And we're going to be talking about how to set up your higher time frames and what it actually means, kind of that analogy that I did using all the previous knowledge that we talked about, such as propositional logic and all these premises, going into that analogy that I talked about, where you have a painting in front of you, a puzzle of a painting, and that execution is the last piece of that puzzle. Whereas what we want to be doing is making sure that it's clear for us and that we just need to slot in that last little bit instead of reversing that process and starting with just your execution. So a couple of things that I want to point out, and showcasing you just the beauty of liquidity and order flow, and kind of the things that I look at where my mind ponders to directly when I look at higher time frames, and how you can pretty much pan out your entire narrative for an entire month, an entire week, an entire quartile, even just using logic and knowing when you need to adapt your plan and when you can go with price action, when you can go with that flow a little bit quicker. So we have the monthly in front of us, right? And it's quite evident what we can see here. If we kind of go back to where we were trading at the start of this year, right, getting that move that many of you guys saw, which was great, where we understand that we've got a range like this, right? Huge range. All of this collection phase, right, is occurring here, and we had one of two things, right? We had an open imbalance to the downside, completely open. This imbalance wasn't even tapped whatsoever, and we had a couple of pockets to the upside which were already tapped, like this one and this one now, which is an open pocket, right? And you can see exactly how once we reacted to that, we anticipated pullback, we played upon the shift zone, and voila. All tech based, right? That's one thing that I gotta understand and convey to you guys, is that I am very good with fundamentals. I know my ins and out of fundamentals, but we as retail traders are only going to be ever so lacking on fundamentals because we don't have the edge on getting that information, such as data releases, quicker than other people, right? You don't have a Bloomberg terminal, neither do I. It's useless because we're not going to be position trading, swing trading. It's good to know your fundamentals. I preach that, and I'm a firm believer of that. You need to be looking at fundamentals. You need to be up to date with the news, all that good stuff. But you can see how just tech based, we were simply trading into arrays, away from arrays. And then here, this is where it got interesting, adapting quickly, whether or not we were going to get some sort of pullback from this, because you go up one more time frame. Hey, fractal, shout out to quartile theory, which is absolute fugazi. But you look at the 3 month, right? You can see that we had an order block here, and in this formation of Q2, pretty much, right, you can see that that was where we were looking at whether or not we were going to close with an imbalance, close, respect this order block, see some sort of follow through, bring euro back to parity, and then we flip. Super simple, right? Flip the script, flip the narrative, adapt. It's that adaptability, how quickly you can adapt on any time frame to what the market is giving you. Never marry that bias, because that is going to be the end of you. The moment you marry a bias because you did all your little pretty charts and everything, is the moment that you will fail drastically, because you are too fond of the effort that you put in, right? Just like what we see on executions way too often. We see people draw their execution analysis on M15, M30, everything below H1, M15, M5, right? They'll draw their sessions, and they're typing out London, they're typing out New York, and got all the beautiful arrows and all that good stuff. And then the fact that you're so dialed in on that, and it doesn't go according to your arrows, you kind of get into this emotional state where you're like, oh, but price needs to do what I drew out. Absolutely not. The market doesn't owe you anything. And this week, yesterday, so of the date of this recording, it's Tuesday, yesterday, I'm going to showcase that example as well. Missed buy side. Because I adapted too late, right? And I'll showcase you exactly that. But first, I want to emphasize this technical lesson on your higher time frames, distinguishing your higher time frames with lower time frames, with your ETFs, your execution time frames, and what it actually means to kind of go from top down, right? Everyone's familiar with top-down analysis. Everyone has heard top-down analysis, whether you're a support resistance trader, harmonic, Fibonacci, EMA trade, all that good stuff. We've all heard what top-down analysis is, and it's to no surprise that trend is your friend is just the logical way of going about it. You don't want to be playing against the trend. At least you need to know the areas where you can and then adjust your risk to do so. This is something that we call counter stage. We're setting up the stage. The stage is the direction in which your opportunities will be most favorable, right? That's what we call pro stage. Counter stage are the moves in between, but they need to be logical, right? Imagine this. You only take high probability setups and your strike rate is anywhere between 40 to 50%, right? And you can even give yourself a little edge. That's kind of like this coin toss, right? Ideally, you want to be where you're above that 50%. Actually, for this analogy, we'll stick to kind of where my end students are sitting, which is like 55, 56. You've got that dealer's edge. You've got the house edge, like what the house has on blackjack. That's what you have, right? That is only when you're taking high probability setups. That entails that you can't assume that just going counter stage whenever, that'll automatically give you a negative edge, right? And obviously you can go into super statistical analogies here and actually say how that is incorrect. I get that, but let's just kind of put it on paper. If your strike rate is 55 plus 60% on just high probability setups, trading towards that high probability area where your odds are stacked automatically is a bad idea, right? This big issue, and that's kind of what you see doing. So it's like, hey, we have a high probable scenario trading and on execution time frame, you'll see that having this POI, this area, and it's like, okay, from there I'm in discount, right? I'm waiting for some sort of entry pattern. I've got H1 H4 stacked, and voila, trading towards that automatically puts you against your edge. So you need to have areas that are logical when you go counter stage. That's what I'm trying to say here. That's a whole different lesson. I'm deviating just a little bit from the main core that I wanted to talk about. So let's go back to that. So we talk a little bit about higher time frames, right? Monthly is kind of where you start. On the monthly, you have very, very clear things to do, especially with EU. Monthly chart is at the moment very, very self-explanatory in my opinion, without going into too much micmac and drawing imbalances and BPRs and stuff like that, which are overlapping, which you can do. You got to understand one of two things, right? How your 3 month looks like, right? This is our 3 month, right? What you can see here is that we've got this huge down candle before this up candle, and obviously in the next 21 days when we close off Q3, we will be creating Q4. We'll be going into Q4, which could give us something along these lines, right? Just like that, we understand that there's a probable area that opens up pretty much legway for us to pull back, use these arrays, and then continue. Super simple stuff. It's really not rocket science when you look at it like this. What are we, and you always need to understand when you're, let's say, looking at these specific type of time frames, specific type of timings, and this is where all these ICT fanboys will go time and price. It's common sense, right? End of the day, end of the week, end of the month, end of the quartile. You can already know how a candle is forming, right? You just got to be ahead of the game. You got to just use your brain a little bit and be like, oh yeah, sick. In 21 days, if we close here, we'll have a bullish array. Simple as. That's kind of what you got to have in the backbone when it comes to higher time frames, right? When it comes to your monthly, you want to know what your monthly candle is doing, right? In this case, we are expanding to the upside. here what we noticed is that as much as we wanted price to come down to, let's say, high traffic, what we call high traffic here is pretty much the area where price can find absorption in price. Why? Because there are arrays here, arrays such as imbalances, which if you want you can overlap them with small BPRs. Very, very cool, but let's not go into those details just yet. At the end of the day, this is kind of how to keep it simple. This is what we had high traffic from this point onwards, kind of this top of here. You can see how this got used up very, very nicely. Cleanest shift zone ever. If you were with us, you understood that this was very, very valid to take. Breaking above these highs right here, you can see price then distributed in this pocket right here, pulled back, and then we managed to trade up until this local high as well. You can already see your fractility, how this looks like on weekly. On the weekly, this was the cleanest movement ever. Then obviously off the backbone of summer period now, July into August, we have a little bit of an inside range trading, where now we've taken range low into range high, with obviously the backbone that there's this open pocket below. Cool. Most favorable scenario was going into this high traffic, which we didn't get. So that's kind of where this adaptability comes into. You don't want to be too married on this whole short bias if price flips bullish. You just need to learn to adapt. So now what we can tell is we're early on in the month of September on the date of this recording, and how is this candle, this monthly candle forming? How does it look like? We're already penned lower, right, in this kind of bullish candle right here. Not necessarily, this is not an engulfing candle whatsoever, but what can we anticipate? That we already kind of have this pullback in. So odds of low of the month being in are there. They're not promised because there are still many arrays below us, but odds of us doing a whole retracement here off the backbone of 10 cents, let's say, or at least 7 cents on this exchange is very, very minimum. So that's how you got to also look at your higher time frames in a very tangible manner. You know, you're trading EU. What does it mean when we drop this entire distance on a candle? What is the percentage change? Is that realistic? Do we need a fundamental catalyst to spark that? These type of things. And once you combine that, it's very, 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 very easy to understand, okay, hey, this expansion off the backbone of some sort of fundamental catalyst, such as Trump saying some stupid shit, is very logical. And you don't put those puzzle pieces together hoping and praying that it's going to be a catalyst, but you can see and assume how it could go from one end to like spiral out and lead to an expansion in these specific areas. So the monthly, your goal with the monthly is to do one of two things. Your entire higher time frame on the monthly candle is just to choose a side of, okay, that's most probable. Where is price right now? Where did price come from? Pretty much from the bottom of this leg. Since the start of this year, we've had a very bullish year. And where is price most likely to go to? You know, at least a little bit higher, right? If you were to just pan your odds of, okay, hey, this is EQ of the range, and I don't even need to draw the dealing range, but just say like, okay, if this is the move down, this is EQ. We've taken liquidity lower. We've taken distributed liquidity higher. There hasn't been this pullback, but overall, what can you notice is that there's bullish order flow. Like even a blind person, if you were to just describe this on Braille, they could understand that, right? Not to sound passive aggressive, but you get the gist of it, right? Your monthly on each, and now it may be a little bit confusing because we're playing monthly on monthly candles, and that's just tough. But what it comes down to is with your higher time frames, you just need to choose and understand, hey, these are the direction of the water. This is where the wind is helping me out, right? Terrible analogy, but you get what I'm trying to say here. In this case, it's bullish expansions, right? There's very little reason for us now to believe that price is going to go to this to these areas right here. It would only make sense if we maybe sweep that high like this, maybe land in that pocket, and then go lower to then go higher. That would make a lot more sense. But at the moment, we are looking at, you know, sure, we're taking previous monthly high at the moment, great, we could get a deeper reaction. We'll look about that. But then you see that price is fractal. You go into the weekly, you go into the daily. But at the moment on the monthly, all of our argumentation looks like we want to go higher. So I hope that that is kind of clear for you guys. Then we go lower, right? Monthly, weekly, those are your clear higher time frames. Daily acts as a middleman between those two, and H1 acts as the middleman between pretty much your H4 and your execution time frame. Both of those are like glue, right? Those are the easy time frames to see what your fractility will do and what it entails when price is fractal. So we go on the weekly from this, and you can see one of two things. Not the nicest summer period, obviously. This has been complete dog water in my opinion. Although we had a very, very good June, right? June was great, July was doable, and we wrapped up August very, very nicely in my opinion. But it's quite clear, right? You know, we're trading into array below EQ, and we really want to see this, but it's not the nicest, right? Don't get me wrong, I don't really like this. So the weekly, it's the same thing. Ask yourself the same questions. Hey, where is price right now? Right here. Where did price come from? From this leg, it came from these lows right here. Not the nicest, right? But where is price most likely going to go to? This local high, right? If you can't answer the second question, you got to go a little bit back and ask yourself, hey, what is the order flow that is holding? And then you'll quickly come to the conclusion that the most recent array that has been respected is this bullish imbalance. Voila. Then it created in this leg upwards. You follow it, you trace it, you create it, and you're like, oh yeah, cool. Then price is holding this imbalance as well. There is obviously body closes below. It's not the nicest, right? It really isn't the cleanest. But then you see, hey, add a little bit of timing to that, a little bit of fugaze, but logical summer period. Hey, what was this? This was obviously when volume was low. To no surprise, all of July right here. This was summer vola, right? You can see prices transactable. Why? Because there's not a lot of aggregated liquidity on the markets. We've seen this over and over and over again. All the liquidity is at the Bahamas. So what you can conclude from that is that it's super simple. We're holding world's grossest order block right here, not the nicest. You can see it's an inside bar. It's an indecision candle, not too clean, but you can see that there's buyers pushing price higher, sellers pushing price lower, and all of this kind of finding that EQ as your fair valuation right here, right below EQ. My arrow's spot on there, but you get this right below EQ. That's kind of the only reasoning. There's something that we can do here in these cases, and I'll give you a hint, but I don't want to go over it yet because it's a little bit advanced technicals. That's going in between fractals, right? You can go into daily, you can go into H12, H8, just to like what you're doing there is to solidify your narrative, right? The issue is many people do that on execution timeframes. On which timeframes can you use fractility to your advantage? Your higher timeframes. Don't use fractility in your advantage on lower timeframes, right? M15, M5, those are your fractals. Don't go into like M30, M45 just because you want to find arrays, right? You have clear rules, you have clear stuff, but using stuff like H8, H12, if you are like uncertain about something on daily is okay, right? Because those are still higher time frames. What you want to see is order flow being respected, arrays being created, arrays being mitigated, or arrays being induced, simple as. So the weekly acts exactly as the same type of thing, right? You add a little bit of understanding of cyclical price patterns, in this case just summer volatility, right? Summer vola, and we can understand, okay, hey, price was quite transactable, it was consolidating, nothing too special, not really too worried about that, but the conclusion is still the same, right? You can see that we're holding this. We're not even using DXY as a cross reference. We'll get into that later, a whole video about DXY and what it means and how you can't use it with GU. We'll get there, guys, we'll get there. But this should be kind of self-explanatory. So again, ask yourself these three questions. Does it make sense to reverse all the way to, like, let's say this imbalance right here? Absolutely not. You know, it has been tapped, but max midpoint open. No, Don't do it. Don't think about that. At the moment, you've got a very, very clear range, right? If you were to take the bottom of this range, oh, where did that go? Bottom of this range all the way to the top, right, like this, you get the gist of it. For some reason, we've got that there. Oh, there you go. Cool. So this is what you're playing. You're at your extremes. Price gravitates towards extremes. Wants to take extremes out. Obviously, we can look for some short-term shorts once we take this out, if we create some sort of array, but there's very little array to take out. So maybe we take all this resting liquidity out before we go into higher time frames and go continue to pretty much all those highs that we have here, right? That we had on the monthly. Sure, it might not be super eventful now because it's a whole change of nearly 3 cents, but we said the same shit here. We were like, oh, we're never visiting 115 again. We visited 115. We're trading at 117 now. Likewise here. And here it was like, oh yeah, we can obviously bounce back off the 3-month order block, right? Targeting these lows again, and then we'll revisit parity. Adapt or die, right? That's pretty much how this game is, and that's how you need to see your higher time frames as well. So I realize I'm talking quite a bit. That is your higher time frames. I hope you guys kind of understand how I look at higher time frames and how you need to ask yourself, relay these questions with yourself to make the most sense of these higher time frames. After that, we're going to go into maybe lower time frames on Thursday, Friday. Tomorrow, we're going to do a little bit more of a check-in, a little bit more of that logic-based stuff. And from there, we'll go over potentially a couple trades. What I wanted to wrap off with was this M15. Yesterday, let's showcase a little bit of that M15 adaptability from yesterday. Here, beautiful stuff, was very, very cool. Right here, actually I'll save that for my technical breakthrough of this week. Obviously I was in longs here as well. Off of this backbone, managed to get some partials out, the rest taken out break even, and now we're looking to see what we can do in New York. But this great tool, understand your fractility, understand what is formed, all that good stuff. So thank you. That is day 7. I hope you guys learned a little bit about higher time frames, and I'll see you guys in day 8.